Okay, sorry. Okay. Well, I don't think it's going to take us that long.
No, it doesn't take us that long.
But it might take you that long?
On our own.
Yeah. But what you need to do is get to where it doesn't take you, I'm sorry, but that's kind of a...
We got 31 the other day.
Yeah, but this one has lines on it.
This one has lines, yeah. Because we're going to do that one in class today. So, you know, not to have to
Yeah, that's
do
right.
that.
We made Alex make lines yesterday.
Yes, we did. Yes, to the line. So, here we go with, there he is. So far, let's go down our outline a little bit and see what we've learned so far. In this chapter, we're talking about subsequent to date of acquisition. And we've learned that the parent can use one of three methods to account for the subsidiary. And while they probably should be using the equity method, because it's easier, sometimes they use the cost method or initial value method. And then every now and then they use the partial equity method. We did problems 1, 2, and 4. And then we did the set F, S for subsidiary stuff, A for allocations, I for investment income, D for dividends of the subsidiary, E for expenses of amortization, and P for entity payable receivable. And we did problems 9 through 11. I believe we did 20, 24, and I know we did 26, and that was a problem. So, the next section is what happens when the acquisition happens during a fiscal period rather than on January 1st or December 31st. And most of the time, everything is the same, except that the entry S is going to be different to reflect the beginning of the year. There's an illustration, pages 95 through 97. I will let you do that on your own. And instead, I'd like to get to Roman numeral 3 here, which is for a combination where the parent has used something other than the equity method. So first of all, if they've used the initial value method, and again, we're looking at those 4 T accounts that you have memorized by now. Okay? And so the parent has used these two for the cost or fair value or initial value. The investment in subsidiary, the asset, is just the purchase price and it doesn't change. The investment income, we usually call dividend income, but don't let that throw you off. It may be investment income. Okay? And that would be just dividends. That would be our share of dividends, which is 100%, right? Because that's all we're talking about, is 100% ownership. So all that we would have is these two journal entries, or each year we just have this journal entry, rather than what we would normally have, so that's the cost or initial value method. The equity method, the investment goes up and down and up and down. The purchase price continues to change for our share of net income, goes down for our share of dividends, and for the amortizations, and up and down and up and down and up and down. So, and then investment income does not have the dividends. It has our share of net income and the amortization. So if the parent has been using that method instead of that method, we've got a couple of problems. Number one, these 3 things have not been changed. They have not been recorded. You follow? Number 2, instead of recording this for income, we've been recording that for income. So what we need to do is remove this for all prior years and record that for all prior years. star C. The star C, and let's go to page 98, the star C. For initial value, also called cost method or fair value method, is going to be, we need to add in prior year's net income. We need to subtract out prior year's amortization, and that's to record them. But we also need to subtract out the dividends, the prior year's dividends, because they don't belong there. So that is the computation, is we have to figure out what were the prior year's net incomes, how many years of amortizations, to record these, to remove that.
You said star C. I was thinking like set up like 5 things, but it's a little star.
You mean 6 things? Yeah, no, it's, whenever we do stars, and we're not doing chapters 4, 5, and 6, but whenever we do stars, that is a date alignment. It is, all the stars are done before you ever do setup. Or when we get into chapter 6, you have a B, you have a star B. So you would do star B before you did setup, but B you would do after setup, or after all the stars. So all stars are for purposes of getting retained earnings back to where it should be. They're all date alignment, getting retained earnings. It's all the prior years bringing forward the snowball. So all the stars are for the snowball. The ones without stars are the current year's things. Does that make sense to you? Okay, so
You would have to do this once for each year, right?
you will continue to have
Until
a
you
star
get back
C.
to-
Yes, and star C stands for conversion to equity. Conversion to equity. So I said page 98. Let's go to 98. There we go. Page 98. Get there. And it says to you, no, that's, okay. I'll let you read that. Let's look at page 99. Now, how would I know, and this was one of the questions you asked last time, how do you know which method the parent's using, right? And I told you I'd put that in words. So, if the investment account equals the purchase price, then we're using the initial value or cost method, right? If not, if the investment in subsidiary does not equal the purchase price, then we're using either equity or partial equity. So far, so good. Right? So the first thing you look at is the assets section of the balance sheet to see if the investment account is still the purchase price. If it is, ta-da! You've just got the initial value method. And the parent's income will be dividend income, like it is on page 99, which will be equal to the subsidiary's dividend. So step 1, but step 2, you say, okay, and if this happens, if it is initial value, then look on page 99 with me, and you see that it is still $800,000. Page 99. On the balance sheet, investment in Sun is still $800,000, which was the purchase price. And this is 3 years later, or at the end of the year, no, at the end of the first year. But either way, it hasn't changed. They've been doing this. And look in the income statement section, the top one, and the parent has dividend income of $40,000, which is equal to the dividends declared in the retained earnings section of Sun, $40,000. You see? Because when son debited dividends and credited cash, parent debited cash and credited dividend income. So far, so good. All right. If, however, it's not the initial value method, then we need to decide, is it equity or partial equity? And the easiest way to look at that, if the investment income, that would be on the parent, is equal to subsidiaries' net income, then it's partial equity. If it's not, then it is equity, because it's subsidiaries' net income minus amortization. Eric?
Could you say it's like if the equity earnings of the, or equity earnings in the subsidiary is not equal to the net income, then it would be partial equity?
Correct.
Okay.
Now, obviously, in chapter 4, 5, and 6, when we have lower than 100%, then you'd have to multiply subsidiary net income by 80% if that's all they own, and that would be investment income. But for our purposes, we're doing that only at 100%. Okay? All right, so if you look back on page, where we have the equity method, page 97, you apply this. Investment is no longer $800,000. It's $1,082,000. So we know it's not initial value. And we go to the second step. The investment income is $153,000, which is not the $160,000. Everybody see that?
What page?
97.
I see
The
the 163.
153 is in the parent's income statement. The 160 is the bottom line of the subsidiary's income statement. If that 153 was 160, it would be the partial equity method. But it's 153, so it's the equity method. It also tells us that amortizations are the difference between the 160 and the 153, which is $7,000.
Is that the amortization per year, or is it just total?
In total,
Okay.
which was a 13,000 positive and a 6,000 negative, when we went over that, right? Which was 7. So now you know how to figure out which method it is. Does this help? Okay, so now we're back on page 99. So what do we do with that? Well, the first thing we're going to do is we're going to, we don't have any prior years, because this is the end of the first year on page 99. And all we're looking at for star C is prior year's net income, there isn't any. Prior year's amortization, there isn't any. Prior year's dividends, there isn't any, so there's no star C. There is no star C. We haven't closed anything yet. It's the first year. Okay? But if you look on page 105, for that third year, the income, the dividends were $70,000. Okay, see they've got them in a box on page 105. Everybody see that? Okay. We do have a star C. Do you see that? What they need to do is change the investment account for the stuff that would have happened in the prior years. This is 17, so we have 2014, 15, and 16, 3 prior years, and 1 current year. For the 3 prior years, we'd have to compute the prior year's net income, the prior year's amortization, 7,000 times 3 is 21,000, the prior year's dividends for those 3 years. And they did that for you on page 103. Previous years, if they've been using the equity method, this exhibit 3.11. If they've been using the equity method, the parents' retained earnings would have been increased for our shared net income and decreased for amortizations, right? Net income, amortization would have been closed to retained earnings. 2014, 15, and 16. But what we closed was dividends. So we need to remove the dividends and add in the net income and subtract the amortization for all 3 years, and they will affect this account and retained earnings of the parent. So we're converting it kind of like we did back in chapter 1 when we were using the cost method, and then we were able to have the ability to significantly influence, and then we had to convert to the equity method. It's the same kind of thing. That's what Star C does. We're just making that adjustment, but we're only doing it on the worksheet. We're not doing it on the parents' books. So that the difference between the 309 and the 110 is 199,000. How did I get that? You go back to the income for each year. And I'm looking now on page 96 at exhibit 3.6. I've got the income for 2014, 15, and 16 of 330. So add that. I got the amortization for the 3 years as 21. I subtract that. And I have the dividends for all 3 years as 110. I subtract that and I get 199. All I'm doing is making the books look like, for investment and retained earnings, that I've been using the equity method. That's Star C, conversion to equity.
So that's, if them did cost and they're supposed to do equity? Or?
They can use anything they want, because what happens if you compare page 97 to 99, let's see, no, not 99 because that's different years, well, if you compared, what's the 2014, 94 to 99 to 100, the consolidated totals are identical. But the beginning numbers are different. The beginning numbers are different. Your investment balance is different on all 3. Your investment income or your dividend income is different on all 3. But your consolidated totals are the same. So why not let the parent just use their easy stuff, and we who are doing the consolidation, who are the upper level managers of doing, the reporting, we'll do the Star C. We'll let the bookkeepers do the easy stuff, the initial value method. And at the end of the year, we just know how to do it. Yes, sir.
Are we gonna Star C on our final exam?
Yes. You may. I'm not sure which problem. Yes. So you need to memorize this Star C for initial value. There is another difference. You have a modified D. Your modified I, no D. Modified I, no D. Because, as you remember, your I, SAIDEP, your I was a debit to investment income and a credit to investment. That was the I on the equity method. And your D was a debit to investment and a credit to dividends. Right? Well now, since we did this method, it's not in the investment, so your modified I is that. Pretty cool, huh? And no D. So you mush the I and D together for initial value. Because the investment income is actually dividend income, and it goes off exactly against the dividends.
Is that only when you're doing Star C, or just every time for cost?
In initial value, you will do a Star C, and you will do a modified I, no D. Initial value, you could actually do the I and the D and it would be fine. It wouldn't hurt. And you could just do in this case, the 40,000 both places, okay? But it's a modified I, no D for initial value. are we doing? This is not hard, right? What we've done is we've learned how to consolidate with the equity method. Now we're learning how to turn it into the equity method and then do setup. Questions so far? But wait, there's more. There's one more. And that is the partial equity. The partial equity, the only thing that's missing is that. Because they've done this, they haven't done that. We don't have to do that because they already did. We don't have to remove that because they didn't. So it's just the 21,000. The crazy thing is, this is usually a positive number because your net income is almost always bigger than your dividends and your amortization. So if this is a debit for your initial value, it's a debit to investment and a credit to retained earnings. But because under the partial equity method, all it is the negative part, the amortization, it's almost always a credit to investment and a debit to retained earnings. Because all you're doing is recording the amortizations, which is an expense, which makes retained earnings go down, debit. Make sense? So if you look on page 100, again, you don't have a star C because you don't have prior year's amortizations. The only thing that's different here than on the equity method is that instead of it being $93,000, it was $100,000 because they didn't record the amortizations. But no modified I, no modified D, nothing different. Okay? It's just, it is a different number, but it's the same entry. You go find the parent's investment earnings and get rid of it against the investment. What's the matter, Hunter?
The Gators hired a new coach,
Who'd they hire?
Jim McElwain.
And you're not happy with that?
Wasn't my top choice.
Well, at least they hired a new coach. What's his
From this-
background?
He was Alabama's offensive coordinator.
So we got another offensive
Another
coordinator?
Saban coaching tree too. Because Muschamp was from the Saban tree, and this guy's from the Saban tree.
So it's more of the same.
But Muschamp was defense. This guy's offense.
Okay, all right. Well, what we need is a head coach.
He was
took
their
a 1 and
offensive
10
coordinator.
team to 10-2.
Yeah, and he was their offensive coordinator when they won the two championships. And his quarterback this year was #1 in the nation, and he had the #1 wide receiver in the nation. So,
Okay, well, we can hope. Go Gators.
all right, brain breath.
Okay, yeah. Okay, so let's look on page 106. This is the partial equity method 3 years later. So you ask yourself two questions. Which method are we using? How many prior years? How do I know that I'm using partial equity? I go through these steps. The purchase price, the investment is no longer $800,000. I know it's not initial value. So I go to this step. My investment income equals the subsidiary's net income. You see it? The $160,000 equals the $160,000. Everybody know what I'm talking about?
Where was it?
Okay, look on the income statement. Parrot has an income of $160,000 from Sun, their dividends. And Sun has a net income of $160,000. That's the same number. Right? That means partial equity. When it was full equity, it was 153. 160 minus the 7,000 amortization equals 153. Okay? But because there are prior years, the star C is only the amortizations, 21,000. You see the star C? By the way, the star C is not changing the subsidiaries' retained earnings, it's changing the parents' retained earnings. So in our consolidated retained earnings, it will still be the parents, but it will be as adjusted for the star C. So that consolidated beginning retained earnings is no longer $2,065,000. It's now $2,044,000, which is what it would have been had they been using equity method. And on page at 105, it's no longer $1,845,000. On page 105, it's again been 2,044,000, which is what it would have been had they been using the equity method. So all three methods, their beginning retained earnings is the same. It's just how we get there that's different. Are you following? So it's not like we're learning 3 sets of procedures depending on which method they're doing. All we're doing is converting it to equity so we can do our setup. Yay! All right. What do I want to do now? Now that I've told you that, let's go to problem 5, 15, 16, 25, 29, and 31. We won't do 29. We will do 5, 15, 16, and 31. We'll do and then if we have time, we'll come back to more. I would rather do, and I think you would too, another worksheet together than for me to give you more about bargain purchases and goodwill impairment, and because a lot of that you can get on your own. Contingent consideration. You saw on your review sheet there's not a lot on that, right? So I'm not testing that a lot. I am testing the worksheet a lot. 75 out of 150. Okay, so number 5. How we did number 4, I believe. Kimmel has equipment with a book value of $190,400, fair value $357. What is consolidated balance for the equipment account as of December 31st, 2014? And the answer to number 4 was A, $574,000.
What page is this?
123 was problem 4. And the answer we already solved, I believe, was A, Apple, $574,000. Okay, everybody with me? So problem 5 says, how would the answer to problem 4 have been affected if they used the initial value method? It'd still be $574,000. So the answer is A, Apple, no effect. The consolidated balances are identical. It's just getting there that's different. There's only one time that the book screws you up over this. And that's when they say, what if the beginning balance was this?
Well, it wouldn't be because they're all the same.
Well, and see, but if they start with the same beginning balance for investment, then you're going to have different consolidated balances. You see what I'm saying? In real life, you would never have that. You would have different beginning balances, but there's at least one problem in the book that they say, what will happen, what would the consolidated balances be if this is your beginning balance? And that, I think, is very confusing, because in real life, that would never happen. You'd have a different beginning balance, but the same ending balance. Does that make sense to you? So if you get to one that you say, I don't understand why it's a different ending balance for the different methods, just X that one out, okay? If I could remember which one it was, I would tell you which one I may have X'd it out. No, I don't think I did. Number 23, I put a question mark by it, so it may be that one. That was number 5. Number 15, Herbert acquired all of Rambus on January 1st, 2014 for $574,000 cash. Excess amortization of $12,000 results from the transaction. So they've already told you that they've done the DDES. Out to the side, the total annual amortization is $12,000. All right, they kind of fast forwarded through that. On the date of the takeover, that Herbert reported retained earnings of $400,000, Rambus reported a $200,000 balance. Herbert reported internal net income of $40,000 in 14 and $50,000 in 15. So now we see that we have how many prior years? 1 and 1 current year. 2014 is a prior year. 2015 is a current year. And declared 10,000 dividends each year. Rambus reported net income of 20,000 in 2014, 30,000 in 2015, declared 5,000 of dividends in each year. Okay. So assume that Herbert's, part A, internal net income figures above do not include any income from the subsidiary. So they're just doing their revenues minus their expenses. They're not putting in that dividend income or investment earnings or whatever, earnings from investee or whatever they call that. So they're just keeping it clean. Sometimes they do, and you have to minus that out. All uses the equity method, what is the amount reported as consolidated retained earnings December 31st, 2014? 14. This is part A. And then would the amount of consolidated retained earnings change if they've applied either initial value or partial equity? Well, the answer to the second question is no. It'd be the same. Okay? But that's the first year. There's no star C because we have no prior years in 2014. And so they want you to look at that. Consolidated retained earnings would be beginning retained earnings of the parent plus consolidated net income minus consolidated dividends. Consolidated net income would be, and I will give you plenty of time to write this down, okay? It would be, so here's beginning retained earnings of the parent. We would eliminate the subsidiary's retained earnings, so that's of no consequence. That would be done in the S. Then we would have Herbert's income and Herbert's dividends, Rambus's income, not included in the parent's income, and amortization for the first year. And that would be, actually, they ask you for 14, but then they solve it for 15, don't they? Yeah. Okay. Well, if we could stop it right there, that would be consolidated retained earnings at 12/31/2014. The parent's net income, the subsidiary's net income, the amortization is a negative, and the parent's dividends are a negative, right? If they use the equity method, let's go ahead and solve it like if we change that to 2015, it would also be Herbert's net income for 2015, Herbert's dividends for 2015 would be a negative. Rambus's 2015 net income, forget about the dividends, that's taken care of to the D. And the amortization for that year, so consolidated retained earnings would be 496 at the end of 2015. Does that make sense? Any questions about that? Under part B, and then I'll give you time. Do you need time to write this down? I'll give you a minute.